The following comment is this narrator's opinion. The summary of this book, and of all books and interviews of Warren Buffett, is this: put every penny in VOO and leave it for life. The ticker symbol VOO stands for the Vanguard S&P 500 Index ETF. Now I will begin the book. The Essays of Warren Buffett, Lessons for Corporate America, 4th edition, by Warren Buffett. Selected, arranged, and introduced by Lawrence A. Cunningham. Preface. The year 2015 marks the 50th anniversary of Berkshire Hathaway under Warren Buffett's leadership, a milestone worth commemorating. The 10-year sets a record for chief executive not only in duration but in value creation and philosophizing. This 4th edition of the Essays of Warren Buffett, Lessons for Corporate America celebrates its 20th anniversary. As the book Buffett autographs most, its popularity and longevity attest to the widespread appetite for this unique compilation of Buffett's thoughts that is at once comprehensive, non-repetitive, and digestible. The original edition of the Essays of Warren Buffett was the centerpiece of a symposium held 2 decades ago at the Benjamin N. Cardozo School of Law under the auspices of Fitzheyman Center on Corporate Governance. This gathering brought hundreds of students together for a 2-day dissection of all the ideas in the compilation, featuring a series of vibrant debates among some 30 distinguished professors, investors, and managers, with Warren and Charles T. Munger, Berkshire's vice chairman, participating throughout from their seats in the front row. In the 2 decades since initial publication, I have often taught the essays, as this book has come to be known, in my classes and seminars at 4 different universities. The book is adopted by scores of professors at other schools for classes such as investment, finance, and accounting. Investment firms have distributed copies to their professional employees and clients as part of training programs. I am grateful for the positive feedback from these students, teachers, and other users, and delighted to know that the lessons are being taught. As in previous editions of the essays, this one retains the architecture and philosophy of the original edition, but adds selections from Warren's most recent annual shareholder letters, including his 50th anniversary retrospective. All the letters are woven together into a fabric that reads as a complete and coherent narrative of a sound business and investment philosophy. As an aid to all readers and to enable readers of the previous editions to see what is in this new one, a disposition table at the end of the book shows the various places in this collection where selections from each year's letter appear. Footnotes throughout indicate the year of the annual report from which essays are taken. To avoid interrupting the narrative flow, omissions of text within excerpts are not indicated by ellipses or other punctuation. The new edition is called for not because anything has changed about the fundamentals of Warren's sound business and investment philosophy, but because articulation of that philosophy is always delivered in the context of contemporary events and business conditions. So periodic updating is warranted to maintain its currency. In preparing the previous editions, I was aided by numerous people to whom I expressed gratitude in those editions, and I want to thank them again. Among those, I especially thank Warren Buffett. His generosity not only made the symposium possible, but his participation enriched it manifold. His willingness to entrust the rearrangement and ongoing republication of his letters to me is a great honor. His partner, Charlie Munger, deserves explicit repeated thanks too, for not only did he participate in the 1996 symposium from the front row, he also graciously chaired, on a moment's notice, one of the panels. He also granted me permission to reprint some of his letters in this collection as well, including his 50th anniversary retrospective. At Berkshire's 2011 annual meeting, Charlie stressed to me how different Berkshire had become in the 15 years since our symposium, and yet how much it remained the same. Back then, Berkshire looked more like a mutual fund, with 80% of its assets in minority common stock positions and 20% in wholly owned businesses. Today, the ratio is reversed, and Berkshire looks more like a conglomerate. Yet then and now, the company and its constituents are united by a core set of common values defined by the tone Warren set at the top of that animate the essays. I thank the many thousands of devoted fans, followers, and friends who have been avid readers of the essays over the past 20 years and look forward to continuing our journey. Lawrence A. Cunningham, New York City, November 1, 2015. Introduction by Lawrence A. Cunningham. Experienced readers of Warren Buffett's letters to the shareholders of Berkshire Hathaway Incorporated have gained an enormously valuable informal education. The letters distill in plain words all the basic principles of sound business practices. On selecting managers and investments, valuing businesses, and using financial information profitably, the writings are broad in scope and long on wisdom. By arranging these writings as thematic essays, this collection presents a synthesis of the overall business and investment philosophy intended for dissemination to a wide general audience. The central theme uniting Buffett's lucid essays is that the principles of fundamental business analysis, first formulated by his teachers Ben Graham and David Dodd, should guide investment practice. Linked to that theme are management principles that define the proper role of corporate managers as the stewards of invested capital, and the proper role of shareholders as the suppliers and owners of capital. Radiating from these main themes are practical and sensible lessons on the entire range of important business issues, from accounting to mergers to valuation. Buffett has applied these traditional principles as chief executive officer of Berkshire Hathaway, a company with roots in a group of textile operations begun in the early 1800s. Buffett took the helm of Berkshire in 1965 when its book value per share was $19.46 and its intrinsic value per share far lower. Today, its book value per share is around $100,000 and its intrinsic value far higher. The growth rate in book value per share during that period is about 20% compounded annually. Berkshire is now a holding company engaged in 80 distinct business lines. Berkshire's most important business is insurance, carried on through various companies including its 100% owned subsidiary, Geico Corporation, among the largest auto insurers in the United States, and General Re Corporation, one of the largest reinsurers in the world. In 2010, Berkshire acquired Burlington Northern Santa Fe Railway Company, among the largest railroads in North America, and has long owned and operated large energy companies. Some Berkshire subsidiaries are massive. 10 would be included in the Fortune 500 if they were standalone companies. Its other interests are so vast that, as Buffett writes, when you are looking at Berkshire, you are looking across corporate America. Examples: food, clothing, building materials, tools, equipment, newspapers, books, transportation services, and financial products. Berkshire also owns large equity interests in major corporations, including American Express, Coca-Cola, International Business Machines, IBM, and Wells Fargo, along with half the equity of Heinz and a valuable option to buy a sizable stake in Bank of America. Buffett and Berkshire Vice Chairman Charlie Munger built the sprawling enterprise by investing in businesses with excellent economic characteristics and run by outstanding managers. While they prefer negotiated acquisitions of 100% of such businesses at a fair price, they take a double-barreled approach of buying on the open market less than 100% of some businesses when they can do so at a prorated price well below that what it would take to buy 100%. The double-barreled approach pays off handsomely. The value of marketable securities in Berkshire's portfolio on a per-share basis increased from $4 in 1965 to more than $140,000 by 2015, a 19% compound annual gain. Per-share operating earnings increased in the same period from just over $4 to nearly $11,000, a compound annual gain of about 20.6%. According to Buffett, these results follow not from any master plan but from focused investing, allocating capital by concentrating on businesses with outstanding economic characteristics and run by first-rate managers. Buffett views Berkshire as a partnership among him, Munger, and other shareholders, and virtually all his net worth is in Berkshire stock. His economic goal is long-term, to maximize Berkshire's per-share intrinsic value by owning all or part of a diversified group of businesses that generate cash and above-average returns. In achieving this goal, Buffett forgoes expansion for the sake of expansion and forgoes divestment of businesses so long as they generate some cash and have good management. Berkshire retains and reinvests earnings when doing so delivers at least proportional increases in per-share market value over time. It uses debt sparingly and sells equity only when it receives as much in value as it gives. Buffett penetrates accounting conventions, especially those that obscure real economic earnings. These owner-related business principles, as Buffett calls them, are the organizing themes of the accompanying essays. As organized, the essays constitute an elegant and instructive manual on management, investment, finance, and accounting. Buffett's basic principles form the framework for a rich range of positions on the wide variety of issues that exist in all aspects of business. They go far beyond mere abstract platitudes. It is true that investors should focus on fundamentals, be patient, and exercise good judgment based on common sense. In Buffett's essays, these advisory tidbits are anchored in the more concrete principles by which Buffett lives and thrives. Corporate governance. For Buffett, managers are stewards of shareholder capital. The best managers think like owners in making business decisions. They have shareholder interests at heart. But even first-rate managers will sometimes have interests that conflict with those of shareholders. How to ease those conflicts and to nurture managerial stewardship have been constant objectives of Buffett's long career and a prominent theme of his essays. The essays address some of the most important governance problems. The first is the importance of forthrightness and candor in communications by managers to shareholders. Buffett tells it like it is, or at least as he sees it, and laments that he is in the minority. Berkshire's annual report is not glossy. Buffett prepares its contents using words and numbers people of average intelligence can understand, and all investors get the same information at the same time. Buffett and Berkshire avoid making predictions, a bad managerial habit that too often leads other managers to fudge their financial reports. Besides the owner orientation reflected in Buffett's disclosure practice and the owner-related business principles summarized above, the next management lesson is to dispense with formulas of managerial structure. Contrary to textbooks' rules on organizational behavior, mapping an abstract chain of command onto a particular business situation, according to Buffett, does little good. What matters is selecting people who are able, honest, and diligent. Having first-rate people on the team is more important than designing hierarchies and clarifying who reports to whom about what and at what times. Special attention must be paid to selecting a chief executive officer, CEO, because of three major differences Buffett identifies between CEOs and other employees. First, standards for measuring a CEO's performance are inadequate or easy to manipulate, so a CEO's performance is harder to measure than that of most workers. Second, no one is senior to the CEO, so no senior person's performance can be measured either. Third, a board of directors cannot serve that senior role since relations between CEOs and boards are conventionally congenial. Major reforms are often directed toward aligning management and shareholder interests or enhancing board oversight of CEO performance. Stock options for management were touted as one method, greater emphasis on board processes was another. Separating the identities and functions of the chairman of the board and the CEO or appointment of standing audit, nominating, and compensation committees were also heralded as promising reforms. Perhaps the most pervasive prescription is to populate boards with independent directors. None of these innovations has solved governance problems, however, and some have exacerbated them. The best solution, Buffett instructs, is to take great care in identifying CEOs who will perform capably regardless of weak structural restraints. In public companies, large institutional shareholders must exercise their power to oust CEOs that do not measure up to the demands of corporate stewardship. Outstanding CEOs do not need a lot of coaching from owners, although they can benefit from having a similarly outstanding board. Directors, therefore, must be chosen for their business savvy, their interest, and their owner orientation. According to Buffett, one of the greatest problems among boards in corporate America is that members are selected for other reasons, such as adding diversity or prominence to a board, or, famously, independence. Most reforms are painted with a broad brush, without noting the major differences among types of board situations that Buffett identifies. For example, director power is weakest in the case where there is a controlling shareholder who is also the manager. When disagreements arise between the directors and management, there is little a director can do other than to object and, in serious circumstances, resign. Director power is strongest at the other extreme, where there is a controlling shareholder who does not participate in management. The directors can take matters directly to the controlling shareholder when disagreement arises. The most common situation, however, is a corporation without a controlling shareholder. This is where management problems are most acute, Buffett says. It would be helpful if directors could supply necessary discipline, but board congeniality usually prevents that. To maximize board effectiveness in this situation, Buffett believes the board should be small in size and composed mostly of outside directors. The strongest weapon a director can wield in these situations remains the threat to resign. All these situations do share a common characteristic. The terrible manager is a lot easier to confront or remove than the mediocre manager. A chief problem in traditional governance structures was that in corporate America, evaluation of chief executive officers was never conducted in regular meetings in the absence of that chief executive. Holding regular meetings without the chief executive to review his or her performance can produce a marked improvement in corporate governance. The CEOs at Berkshire's various operating companies enjoy a unique position in corporate America. They are given a simple set of commands to run their business as if 1. They are its sole owner, 2. It is the only asset they hold, and 3. They can never sell or merge it for 50 years. This enables Berkshire's CEOs to manage with a long-term horizon ahead of them, something alien to the CEOs of public companies whose short-term oriented shareholders obsess with meeting the latest quarterly earnings estimate. Short-term results matter, of course, but the Berkshire approach avoids any pressure to achieve them at the expense of strengthening long-term competitive advantages. If only short-term results mattered, many managerial decisions would be much easier, particularly those relating to businesses whose economic characteristics have eroded. Consider the time horizon trade-off Buffett faced in managing what he considers the worst investment he ever made, buying Berkshire in the first place. The economic characteristics of Berkshire's old textile businesses had begun to erode by the late 1970s. Berkshire had hoped to devise a reversal of its misfortunes, noting how important Berkshire's textile business was to its employees and local communities in New England, and how able and understanding management and labor had been in addressing the economic difficulties. Buffett kept the ailing plant alive through 1985, but a financial reversal could not be achieved, and Buffett eventually closed it. This balancing of short-term results with long-term prospects based on community trust is not easy, but it is intelligent. Kindred lessons carry over to other sectors in which Berkshire invests, such as the newspaper business in the Internet age, and highly regulated industries such as energy and railroads, in which Buffett sees an implicit social impact between private enterprise and regulatory overseers. Sometimes management interests conflict with shareholder interest in subtle or easily distinguished ways. Take corporate philanthropy, for example. At most major corporations, management allocates a portion of corporate profit to charitable concerns. The charities are chosen by management for reasons often unrelated either to corporate interest or shareholder interests. Most state laws permit management to make those decisions so long as the aggregate annual donations are reasonable in amount, usually not greater than 10% of its annual net profits. Berkshire does things differently. It makes no contributions at the parent company level and allows its subsidiaries to follow philanthropic policies they had in effect before Berkshire acquired them. For 2 decades, moreover, Berkshire used an imaginative program through which its shareholders designated the charities to which Berkshire would donate and in what amounts. Nearly all shareholders participated, donating tens of millions of dollars annually to thousands of different charities. Political controversy over the abortion issue, however, interfered with this program. Political activists organized boycotts of Berkshire's products to protest particular charitable donations that were made, destroying this feature of Berkshire's partnership approach. The plan to align management and shareholder interests by awarding executives stock options not only was oversold, but also subtly disguised a deeper division between those interests that the options created. Many corporations pay their managers stock options whose value increases simply by retention of earnings, rather than by superior deployment of capital. As Buffett explains, however, simply by retaining and reinvesting earnings, managers can report annual earnings increases without so much as lifting a finger to improve real returns on capital. Stock options thus often rob shareholders of wealth and allocate the booty to executives. Moreover, once granted, stock options are often irrevocable, unconditional, and benefit managers without regard to individual performance. It is possible to use stock options to instill a managerial culture that encourages owner-like thinking, Buffett agrees. But the alignment will not be perfect. Shareholders are exposed to the downside risks of suboptimal capital deployment in a way that an option holder is not. Buffett therefore cautions shareholders who are reading proxy statements about approving option plans to be aware of the asymmetry of this kind of alignment. Many shareholders rationally ignore proxy statements, but the abuse of stock options should be on the front burner of shareholders, particularly institutional investors that periodically engage in promoting corporate governance improvements. Buffett emphasizes that performance should be the basis for executive pay decisions. Executive performance should be measured by profitability after profits are reduced by a charge for the capital employed in the relevant business or earnings retained by it. If stock options are used, they should be related to individual performance rather than corporate performance and priced based on business value. Better yet, as at Berkshire, stock options should simply not be part of an executive's compensation. After all, exceptional managers who earn cash bonuses based on the performance of their own business can simply buy stock if they want to. If they do, they truly walk in the shoes of owners, Buffett says. And owners' interests are paramount on executive pay, as with other corporate governance topics Buffett addresses, such as risk management, corporate compliance, and financial reporting. Corporate culture is among the most important yet least quantifiable factors in assessing a business. At Berkshire, culture runs deep. It begins with the tone at the top set at Omaha headquarters by the norms and values that animate this collection. Berkshire's culture also permeates the subsidiaries that call Berkshire home and the managers of the many and varied business units that comprise Berkshire today. Remarkably for a vast conglomerate comprised of a sprawling and diverse group of businesses, Berkshire's culture is uniform and endearing and, Buffett says, will help Berkshire prosper long after he and Munger leave the scene. Finance and investing. The most revolutionary investing ideas of the past 40 years were those called modern finance theory. This is an elaborate set of ideas that boil down to one simple and misleading practical implication. It is a waste of time to study individual investment opportunities in public securities. According to this view, you will do better by randomly selecting a group of stocks for a portfolio by throwing darts at the stock tables than by thinking about whether individual investment opportunities make sense. One of the modern finance theory's main tenets is modern portfolio theory. It says that you can eliminate the peculiar risk of any security by holding a diversified portfolio. That is, it formalizes the folk slogan, "Don't put all your eggs in one basket." The risk that is left over is only the risk for which investors will be compensated, the story goes. The leftover risk can be measured by a simple mathematical term called beta that shows how volatile the security is compared to the market. Beta measures this volatility risk for securities that trade on efficient markets where information about publicly traded securities is swiftly and accurately incorporated into prices. In the modern finance story, efficient markets rule. Reverence for these ideas was not limited to ivory tower academics in colleges, universities, business schools, and law schools, but became standard dogma throughout financial America in the past 40 years, from Wall Street to Main Street. Many professionals still believe that stock market prices always accurately reflect fundamental values, that the only risk that matters is the volatility of prices, and that the best way to manage that risk is to invest in a diversified group of stocks. Being part of a distinguished line of investors stretching back to Graham and Dodd, which debunks standard dogma by logic and experience, Buffett thinks most markets are not purely efficient and that equating volatility with risk is a gross distortion. Accordingly, Buffett worried that a whole generation of MBAs and JDs under the influence of modern finance theory was at risk of learning the wrong lessons and missing the important ones. A particularly costly lesson of modern finance theory came from the proliferation of portfolio insurance, a computerized technique for readjusting a portfolio in declining markets. The promiscuous use of portfolio insurance helped precipitate the stock market crash of October 1987, as well as the market break of October 1989. It nevertheless had a silver lining. It shattered the modern finance story being told in business and law schools and faithfully being followed by many on Wall Street. Ensuing market volatility could not be explained by modern finance theory, nor could mountainous other phenomena relating to the behavior of small capitalization stocks, high dividend yield stocks, and stocks with low price-earnings ratios. The piece de resistance of market inefficiency was the technology and internet stock bubble that blew up in the late 1990s and early 2000s, marked by stock price gyrations and spasmodically bounced between euphoria and gloom without the remotest nexus to business value. Growing numbers of skeptics emerged to say that beta does not really measure the investment risk that matters, and that capital markets are not really efficient enough to make beta meaningful anyway. In stirring up the discussion, people started noticing Buffett's record of successful investing and calling for a return to the Graham-Dodd approach to investing in business. After all, for more than 40 years, Buffett has generated average annual returns of 20% or better, which double the market average. For more than 20 years before that, Ben Graham's Graham-Newton Corp had done the same thing. As Buffett emphasizes, the stunning performances at Graham-Newman and at Berkshire deserve respect. The sample sizes were significant, they were conducted over an extensive time period, and were not skewed by a few fortunate experiences. No data mining was involved, and the performances were longitudinal, not selected by hindsight. Threatened by Buffett's performance, stubborn devotees of modern finance theory resorted to strange explanations for his success. Maybe he is just lucky, the monkey who typed out Hamlet, or maybe he has inside access to information that other investors do not. In dismissing Buffett, modern finance enthusiasts will insist that an investor's best strategy is to diversify based on betas or dart throwing, and constantly reconfigure one's portfolio of investments. Buffett responds with a quip and some advice. The quip is that devotees of his investment philosophy should probably endow chaired professorships at colleges and universities to ensure the perpetual teaching of efficient market dogma. The advice is to ignore modern finance theory and other quasi-sophisticated views of the market and stick to investment knitting. That can be best done for many people through long-term investment in an index fund, or it can be done by conducting hard-headed analyses of businesses within an investor's competence to evaluate. In that kind of thinking, the risk that matters is not beta or volatility, but the possibility of loss or injury from an investment. Assessing that kind of investment risk requires thinking about a company's management, products, competitors, and debt levels. The inquiry is whether after-tax returns on an investment are at least equal to the purchasing power of the initial investment plus a fair rate of return. The primary relevant factors are the long-term economic characteristics of a business, the quality and integrity of its management, and future levels of taxation and inflation. Maybe these factors are vague, particularly compared with the seductive precision of beta, but the point is that judgments about such matters cannot be avoided except to an investor's disadvantage. Buffett points out the absurdity of beta by observing that, quote, a stock that has dropped very sharply compared to the market becomes riskier at the lower price than it was at the higher price, end quote. That is how beta measures risk. Equally unhelpful, beta cannot distinguish the risk inherent in, quote, a single product toy company selling pet rocks or hula hoops from another toy company whose sole product is Monopoly or Barbie, end quote. But ordinary investors can make those distinctions by thinking about consumer behavior and the way consumer products companies compete, and can also figure out when a huge stock price drop signals a buying opportunity. Contrary to modern finance theory, Buffett's investment knitting does not prescribe diversification. It may even call for concentration, if not of one's portfolio, then at least of its owner's mind. As to the concentration of the portfolio, Buffett reminds us that Keynes, who was not only a brilliant economist but also an astute investor, believed that an investor should put fairly large sums into 2 or 3 businesses he knows something about and whose management is trustworthy. On that view, risk rises when investments and investment thinking are spread too thin. A strategy of financial and mental concentration may reduce risk by raising both the intensity of an investor's thinking about a business and the comfort level he must have with its fundamental characteristics before buying it. The fashion of beta, according to Buffett, suffers from inattention to a fundamental principle. It is better to be approximately right than precisely wrong. Long-term investment success depends not on studying betas and maintaining a diversified portfolio, but on recognizing that as an investor, one is the owner of a business. Reconfiguring a portfolio by buying and selling stocks to accommodate the desired beta risk profile defeats long-term investment success. Such flitting from flower to flower imposes huge transaction costs in the form of spreads, fees, and commissions, not to mention taxes. Buffett jokes that calling someone who trades actively in the market an investor is like calling someone who repeatedly engages in one-night stands a romantic. Investment knitting turns modern finance theory's folk wisdom on its head. Instead of don't put all your eggs in one basket, we get Mark Twain's advice from Pudd'nhead Wilson. Put all your eggs in one basket and watch that basket. Buffett learned the art of investing from Ben Graham as a graduate student at Columbia Business School in the 1950s and later working at Graham Newman. In a number of classic works, including The Intelligent Investor, Graham introduced some of the most profound investment wisdom in history. It rejects